get fulfilled. Repeat, manufacture, goods, manufactured in India, sellable or sellable condition, and then at the point of removal from the factory gate. If 5 fulfills, it is chargeable to excess duty. We have understood it. Now, understand, I am a manufacturer. I purchase steel or I purchase any other chemicals. In my factory, a manufacturing process takes place and the finished product goes out from the factory. Correct. So, excess duty is leviable at every point, means the person who manufactured on my backward integration, the person who manufactured the steel from whom I purchased, he also paid excess duty. When I purchased the steel, right, the price included excess duty, say 12% or 14% as the case may be. When I processed it, got the finished product and removed from my factory, I again paid excess duty on that. So, student, assume you are the final customer and you are buying that particular steel almirah. Okay. Then on the product what you are going to buy has got at least 2 or 3 excess duties in the supply chain. The person who manufactures steel, the person who manufacture the finished product, and maybe a person who painted the product, the entire series. So, the end customer is normally chargeable to multiple excess duty. In our country, that is not allowed, or some benefits are given. This benefit is called as Sen VAT credit. Please note the word Sen VAT credit. In full name is Central Value Added Tax, Sen VAT credit. What is Sen VAT credit? In concise, in summary, Sen VAT credit is the amount of duty, the central excess duty that I paid at the time of purchase of the material, right? Whenever I process the goods, get the finished product sold out in the market, that output tax liability shall be reduced by the tax I paid at the time of bringing the material, called as input tax. So, the output tax liability is reduced by the input taxes, and the net differential tax the person need to pay to the government account. This conception is called as Sen VAT credit. This Sen VAT credit concept also applicable in case of service tax. Whenever I will take up the service tax portion, we will be discussing on that. Precisely, this is what we are covering in the Central Excise and Central Excise Tariff Manual, so far as indirect taxes are concerned. We now shift to the another area called as value added tax, the one most important indirect tax regime in our country, and obviously backed by something called as central sales tax, and after that we will go into the service tax. Okay. What is VAT and what is sales tax? Once again, it is an indirect tax. That means I purchase anything. As a students, you go to any shop, want to buy any product, you will find it out on the packet something written MRP inclusive of all taxes. No, that means all the taxes are included in the product, and whenever you are buying, the shopkeeper is collecting some money from you which is inclusive of taxes, and the shopkeeper pay the amount of tax to the respective government account. You go to a restaurant, have some lunch, dinner or snacks, get the bill, find it out the bill is for 100 rupees, and then 12% or 14% or some percentage down the line written called as VAT, value added tax, and you actually pay 114 rupees. The restaurant owner collect 100 rupees for his pocket and 14 rupees they keep it separate, and the month end they deposit to the government account. Indirect tax from here. You are paying the taxes not directly but indirectly. Then what's the difference between sales tax and VAT? Earlier there was sales tax. The sales tax means whenever I sell there is a tax. VAT introduced in our country from 2005 onwards, and the basic fundamental conception of VAT is that whenever there is a change of hand, whenever there is a transshipment, whenever there is a trading activity, okay, then whatever is a value addition, the tax would be levied on that value addition called as value added tax. Try to understand in a much easy example with a very easy example. Say A is a manufacturer of a goods, B is a wholesaler, C is a retailer in a particular district, D is the small retail in the local area, and E is the customer. So, product manufactured by A manufacturer, slowly coming to E in the entire series, and this is called as the product flow movement. In this product flow, manufacturer earns some profit. Why a wholesaler purchase and sell? Obviously for some amount of profit. Why the retailer? They are in the business obviously to earn some profit. The small shop owners, they purchase from the big wholesalers and sell it to the end consumer like you and me, right? So, everybody is what they are doing, they are basically adding some price into it, adding some value into it, and ultimate customer is paying the entire amount, gross amount. The concept of VAT introduced in a way that a specified percentage of taxes, say the VAT tax if it is 12 or 14 as the case may be, because VAT is a state jurisdiction. Please understand, central excise duty was a union jurisdiction, central government publishes the rate changes. VAT is a state jurisdiction, that means every state in our country have a separate VAT act. In West Bengal it is a West Bengal value added tax, in Odisha it is Odisha value added tax, in Jharkhand it is Jharkhand value added tax act, right. So, the state government levy taxes at every value additions. Let us understand the conception. I, that is Mr. B, who was B? B is a wholesaler. B purchased the goods from A is a manufacturer. So, the purchase price, whenever I purchased, right, I paid some amount of VAT which the manufacturer paid to the government account. So, my purchase price is 100 plus 10 rupees, assume 10 rupees is the tax rate, 10% is the tax rate, 100 plus 10, 110 is my purchase price. Then what for I am doing business? Definitely for some amount of profit. So, I add some value into it. How much I added? Say 10 rupees I added as my overhead expense, my establishment expense and my profit. So, I am now ready to sell the product to the retailer at 110 plus 10 percentage, 10 rupees. So, 120 becomes my offer price. Whenever I am going to bill for 120 to my retailer, I also charge 10 percentage on that. So, on 120 10 percentage means 12 rupees. So, friends, students, please understand, in a pharmaceutical company or a garments company, where this distribution network 3, 4, 5 retailers are there, the end consumer shall be bearing all the taxes, multiple of taxes. Government says no. It is only on the value that is being added you pay taxes. So, take the example, manufacturer 100 rupees, 10 rupees he paid taxes, that means 110. So, government already collected 10 rupees. How much government will collect now, right? The wholesaler is selling at 120, 10 percentage on that comes to 12 rupees. The VAT law conception says 12 shall be reduced by 10, that means 10 already government paid, government collected 10 rupees, 12 minus 10, 2 rupees this wholesaler will deposit to the government account. And when the retailer, sub-retailer, distributor, everybody they buy something, add some value, the percentage of VAT shall be applicable on the value additions. Its conception, this entire chain is called as supply chain and called as VAT chain, where output tax liability shall be reduced by input tax credit. Students, please note this particular word, input tax credit. It means the credit for the taxes I paid on the input amount, input raw material whenever I purchase the goods, and that is called as input tax credit, ITC. Okay. The VAT also has the same mechanism like sales tax. It has got its normal return, submission of assessment and others. But before going that, let us have one more conception, what is called as central sales tax. Central sales tax. Repeat, earlier was VAT, value added tax, and this one is central sales tax. The fundamental conception of central sales tax is that whenever goods are manufactured in one state and going to the other state, okay, for sale or for the purposes of sale, then the state where it was manufactured or sold out, that state in legal language called as the appropriate state should collect tax on that. Give you an example to make the subject very clear. X of West Bengal manufactured a product, manufactured some say machinery in his factory at Howrah or some other place in West Bengal. The customer is in Delhi. So, X loaded the goods on the truck and the truck starts moving to Delhi. So, there is a goods. Please note down this particular point for central sales tax. What are the basic characteristics? Point number 1, there should be a goods. That means something is manufactured, something is sold, right? Goods. Then the goods should be moving. There should be a movement of goods where? From one state to another state, from West Bengal to Delhi. Okay. So, there should be a cross border movement of goods. Number 3, the movement should be on account of sale only. That means the goods that is moving from West Bengal to Delhi to fulfill the sale obligation between these two parties, the Delhi party and West Bengal party. This is called as interstate sale, and the sales tax leviable on the interstate sale is called as central sales tax. Absolutely clear? Sales tax applicable on interstate sale is called as central sales tax. True? Now, in terms of central sales tax, one or two conditions needs to be fulfilled. What? The goods should be in the movement, means there should be a movement of goods from one state to another state, and the movement should be precisely for the purposes of sale of the goods. In other words, if the manufacturer manufactures something in West Bengal and supply the goods, send the goods, dispatch the goods to its depot or warehouse or godown in Delhi, it is not a sale. So, even there is a goods, there is a cross border movement from West Bengal to Delhi, the goods are moving even though there is no sales tax, because there is no sale taken place, it is only a stock transfer. Students, note down the particular word. Stock transfer or branch transfer are not chargeable to sales tax or central sales tax, since there is no transaction of sale, no ownership gets changed from the seller to the buyer. In central sales tax, few very interesting issues are there. The normal, what is the tax rate for central sales tax? The tax rate says that there are two categories of taxes. One, there are something which is called as concessional rate of tax. And who are eligible for the concessional rate of tax? The person who are dealers in the particular state is called as the registered dealer. I repeat the word once again. Dealer means, the word dealer, this is a very important definition. Students, please note this word and read definitely. Dealer means a person who is dealing with the goods, including purchase, sale, warehousing, distribution, etc., etc. And once a dealer getting himself registered with the state government authority, state commercial taxes, it is called as registered dealer. Now, I one of the registered dealer in the state of West Bengal, what I am doing? I am selling some goods to whom? To X, Mr. X, who is in Delhi. Assume that Mr. X is also a registered dealer in the state of Delhi. So, two registered dealer in a sale transaction, right? The transaction is called interstate sale. These two registered dealer, if they transact among themselves, the rate of central sales tax is applied at a concessional rate, at a much lower rate of 2%, only 2%, right? And the government says that both of you are registered, both of you are making a sale purchase transaction should be documented by a form, by a prescribed declaration form. That declaration form is called Form C, Form C, A, B, C, that C, Form C. Absolutely clear? 2%. Now the other category, what is the other category? The other category says that if that Form C is not available, or parties are not registered dealer, or parties are not registered in that particular states, then the concession is not available. What will be available? Full rate shall become applicable. And what is the full rate? The full rate means the rate of tax that is prevailing in the state where from the goods are originating, where from the goods are started moving, in legal language called as appropriate state, that is the rate shall become applicable. Okay. If it is a stock transfer or a branch transfer, that means I am the manufacturer and I am supplying the goods to my own stockyard or branch or depot or showroom in Delhi, definitely no sales tax is applicable, but a particular prescribed form need to be produced to prove that it is only a stock transfer and not a sale. That form is called as Form F, A, B, C, D, E, F, form number F, and once that form is submitted, this transaction shall not be treated as a taxable transaction. The central sales tax is much interesting. What it says that if there is an export, that means I am a manufacturer and exporter. Say I am manufacturing leather goods in the state